Welcome to This Week This Morning, the weekly video that gets you up to speed on the week's most important developments for your business and your taxes. I'm going to cut to the chase here. Nothing worth discussing happened this week with the stimulus negotiations. Both sides continue to claim they are getting closer to a deal, but the general consensus is that nothing is going to be passed by November 3rd. So, in the meantime, I'd like to touch on the Biden tax plan once again, since his chances of winning the election have only been increasing since September. The major campaign promise, when it comes to taxes anyway, is that Biden will not raise taxes on those making less than $400,000 a year. Anyone with half a brain knows that $400K in Manhattan, Kansas versus $400K in Manhattan, New York is like comparing US dollars to euros. Similar, but different. Nonetheless, $400K is the magical number that they've landed on. You need to be aware, however, that the tax code and the economy are too complex to presume that you're going to be safe if you're making less than $400K. You very well could be paying more in taxes, either directly or indirectly. From a tax standpoint, one proposal that could increase taxes for those making under $400K is the proposed change in retirement account contributions. I'm talking about your 401Ks, 403Bs, IRAs, etc. here. Currently, when you make a contribution to a qualified pre-tax retirement account, you get a tax savings equal to your marginal tax rate. So if you're in the 35% tax bracket, a $10,000 contribution will save you $3,500 in taxes. It gets a little bit more complicated if the deduction pulls you down into a lower tax bracket, but generally speaking, that's how it works. Under the Biden tax plan, instead of getting a deduction for your retirement contributions, you'd actually be getting a tax credit. This tax credit would be a flat percentage across the board, at least as it's currently understood by the major think tanks out there. Generally speaking, a tax credit is better than a deduction, and that logic would likely hold true for lower income earners, but those earning more than $80K will actually be in a worse position. This is because the tax credit would be approximately 26% of your retirement contributions. So in the previous example of a $10K contribution in the 35% tax bracket, instead of saving $3,500, you'd only save $2,600. And because of the way the tax code actually works, anyone in the 22% tax bracket or above would be receiving a lower tax benefit under the Biden tax plan. The mechanics of how that works is a bit too mind-numbing to explain here, but what you need to understand is that the tax code is too intricate to change one piece in a vacuum without potentially undesirable consequences elsewhere. And this is not some clever ploy to increase taxes. It's just the reality of an absolute statement crashing against a nuanced world. From an economic standpoint, the conservative think tank known as the American Enterprise Institute has found that a 1% increase in the corporate tax rates are correlated with a 0.5% decrease in real wages for those employees. Similarly, the Congressional Budget Office has found that workers pay more than 70% of the cost of corporate taxes. It's probably true that these percentages aren't 100% accurate, but when you're raising corporate taxes from 21% to 28%, you're talking about something around a 3.5% decrease, that is, in real wages. So I'm not trying to sound the alarm bells here, but I am trying to get your attention here that things are about to change if Biden is elected president. The time to start planning is now. We have a little over 2 months of the current tax code guaranteed to us. So you may want to take a tax hit in 2020 as opposed to a Biden tax year. That's it for now. See you next week.